Hello and welcome to the EMEA Investment and Economic Forum Investor Insights. Today I have the pleasure of being joined by Dr. Savvas Savouri, Chief Investment Officer at the renowned London-based hedge fund Toscafaund Asset Management. Given the turmoil instigated in the financial markets by the coronavirus pandemic, we are keen to gain his insights into how a large strategic investor is dealing with the crisis. Dr. Savouri, hello and welcome to our program. Given the current shocks within the financial markets recently, what are the biggest short to medium term challenges now for Toscafaund and your clients?
We have very specific issues and investments. We are heavily invested in the UK. We entered this crisis fully invested, and glad we were. It's simply, we've seen public markets price lower, assets that we think are fundamentally much more attractive. So we're very lucky because being 54, this is not the first time I've experienced these sort of shocks, and none of us here have. So we're dealing with something that we've dealt with before, which is effectively to keep our hands on the assets that we own and, where possible, add to them, because this is not a long-term problem.
So you feel that the coronavirus emergency impact on national economies and businesses has had an exaggerated effect on stock market valuations, despite the uncertainty of how long crisis and COVID-19 lockdowns will last?
Let's be clear, public markets, stock markets, equity markets have a propensity to show irrational spirits. They can be very volatile. They can be volatile by going too high, and they can be volatile by going down too much. And there are a number of factors that you have to allow for. One is a great many market participants haven't experienced this before, a version of this before. You have to be thinking about 2002 for a viral problem like this, and 2008 for a financial crisis, 9/11, again, 19 years. So many participants really, this is their first battlefield experience. And on top of that, a great many of them run quant funds. And what the quant funds have done, and there's been a huge inflow of capital to quant funds over recent years. Quant funds have amplified the markets being exaggerated on the way up, and they've amplified markets being exaggerated on the way down. So public markets do have a tendency to be oversensitive. And I believe that in selling off, they've shown just such a quality. We have to add one other caveat, which is no two public markets are the same. The UK equity market is different from the Eurozone equity markets, which is different from the US and different from Japan and different from China. And this is an international problem that's being dealt with and impacting on a nation by nation basis. Even within the European Union, Italy and Spain are being impacted differently from France and from Germany. So if you're talking about equity markets, you need to know which region you're talking about and what the economic issues relating to each happen to be, and what the local issues for each happens to be.
Given your analysis of the industry sectors most heavily impacted by the volatility in the market, what changes are you making to your investment strategies?
Any industry that relies upon us going about our business. Now, we entered this with a leaning towards UK real estate, the UK economy more generally. And in many ways, once the lockdown is ended, and it will be ended before too long, and the all clear is sounded, occupational demand for property will not be impacted badly for too long. Of course, there's going to be some impact, but we have to basically bear in mind that the lockdown has kept people at home, keep people away from offices and from restaurants and bars. But when the lockdown is removed, people return to their day-to-day businesses, and the economy will restore itself. And in that regard, our fundamental positions haven't changed. We believe exactly in the same stocks and sectors that we were invested in before the crisis and believe that they're going to emerge the other side and far from impaired, very much stronger in fact, because there's one country that we should focus on, and it's the country from which this virus began, China. And it's the country that will basically act, or certainly Beijing will act, in a way that will make sure that the economy of China will recover very quickly, because Beijing will ensure it does. And we're convinced that the positions that we have, that we're invested in, are positively geared to China's recovery. I have great concerns about how the US economy will emerge from this. And there's a general rule of thumb that when the US sneezes, the UK economy catches a cold. Rather appropriate under these circumstances. I think that the UK's engagement with China will far outweigh, the UK's engagement with a recovering China will far outweigh the UK's historic engagement with a faltering United States.
Naturally, the bear market trend now has impacted the overall evaluation of most investment portfolios. However, for those with available liquidity, do you think that there are major or niche opportunities now for currently undervalued assets?
Yes, most definitely. This is not an unusual event. As I mentioned earlier on, stock markets show amplification. They can be over-exuberant, they can go up too much, certainly above what would be warranted fundamentally, and they can undershoot. And let's not forget that around the world there's a great deal of undeployed dry powder capital held by firms in the private equity space, sovereign wealth funds, and they'll be looking to capitalize. But once they think the stock markets have reached a point of capitulation and therefore greatest valuation arbitrage, they're going to come in. And for instance, if you were asking me a question about a sector that looks most attractive in that environment, I'd say UK real estate, commercial property in the UK. This has not been a devastation in war terms. Assets still exist. Occupational demand is still there. Investment demand is still there. And yet what you've seen is property companies in the UK suffer some fairly significant share price impairment. So yes, there are value trades that you seldom see outside of a crisis like 2008 or 9/11. And the same thing again. This is not, for someone in my generation, this is the fifth or sixth campaign, sort of war campaign that I've lived through. And I'm hoping to capitalize upon the experiences of the past.
In terms of Toscafund's investment approach, what can it offer to the new investors given the current market dynamics?
Experience of market volatility in the past. The average age here of the partners begins with a 5. We've all had at least 30 years experience in frontline commercial finance, which means we've, as I mentioned, we've seen crisis after crisis after crisis after crisis, and that experience is incredibly valuable. And particularly in the context that so many market participants are seeing a crisis for the first time. So many market participants think that it's a simple case of quant modeling. Let's be honest, between different universities, between academics at Oxford and Imperial College, scientists are struggling to reconcile different modeling methodologies about the spread of the virus. So imagine if you've got that contrast in medicine. In finance, you've got lots and lots of confused signaling from investors. And quite frankly, a great deal of it is inexperience. And that's the one thing that we have. We have a great deal of experience.
That obviously represents a formidable wealth of crisis market investment experience. Is there anything different about this crisis and your investment approach through it?
Every crisis is different, is unique. Having said that, you can draw from past experiences, and you can create a sort of a photo fit or a montage of how different crises resemble this one, what isn't relevant and what is relevant. Take 2008. What you had there was an underlying collapse in banking sectors in the US and across Europe. Banks this time around are fundamentally strong because they were forced to be strong over the last 12 years by regulators that insisting that they build up their balance sheets and put in some pro-cyclical defense mechanisms, which they can now draw upon. And this is more like 9/11. You had an event, a shock event, the horrible terrorism that we saw on September 11th. And this is a shock event. And the question is, how long is the half-life? How long will the aftershocks from this last? And quite frankly, I think that we mustn't exaggerate or overestimate the length of the aftershocks of the half-life. This time next year, certainly in the UK, I think business will have more than recovered. I can't be so sure about the United States for a whole wealth of reasons. But I do know one thing. China will not let this interrupt the growth it's been managing perfectly for 18, 20 years. And if China doesn't see an interruption to its growth, then anyone investing in sectors that capitalize upon China's growth will benefit.
Do you think there is a chance that this crisis will at some point turn into a banking crisis?
Banks had their crisis in 2008, a very serious crisis. Banks were nationalized, closed. Because of that crisis, they have had 18 years to fix themselves and almost to over-defend themselves, if you want to put it that way. And that defensive layer is very welcome now. So banks, certainly in the UK and across Europe, have capital buffers that they may not have had there not been a regulatory requirement that they built up pro-cyclical buffers. But no, I don't think there's a banking crisis coming.
How do you think the current crisis and the exposure of the susceptibility of all markets to viral pandemics will change national and regional healthcare and emergency planning policy over the long term?
Oh, that's a very good question. We will never have the same approach to healthcare again. Intensive care units will be increased. The capacity to hold vaccines or develop vaccines will be increased. Supply chains, not simply supply chains in medicine, but in general lifestyles. That how we hoard food and products will change, because we're going to think about this. This will leave some sort of fairly important lifestyle changes behind it. Not all bad things. If you think about where we have been, we came into this crisis believing in what was known, or has been known as just-in-time supply management. The idea was that you just got your materials in enough volume to produce things, send out straight away. The inventories were kept very lean, and therefore warehouses were kept very, very, very lean. Going forward, what you're going to have is every small business and every large business, every small household will insist, and every government will insist upon inventories of non-perishable goods. And that will require warehousing. It will require increased demand, increased production to meet increased inventory demand. So what you have effectively is a positive boost to economies from this in a strange way. What we mustn't do, so I'm speaking as an economist and working in commercial finance, what we mustn't do is allow this to return us to protectionism, because what's going to happen is that every farmer around Europe will demand from their government that they be looked after so they can provide food supply security. Industries will start saying, we are very important to the national security of the country, and to avoid being exposed in the future to another pandemic, we need to give us protection from competition. But we mustn't go back down the slippery path of protectionism. We need to emerge from this with stronger supply lines, inventories, bigger inventories, but not protectionism, because global economic growth relies upon free market access. And we mustn't lose that.
Are there other specific issues, challenges, or opportunities that you believe investors should be more aware of going forward?
Yes, what you've had across the Eurozone, Japan, the UK and the US is, in essence, money printing, often in the sort of modern terminology, known as modern monetary theory, effectively dropping money into families and businesses. So what you've had is the normal currencies that we deal with, particularly the dollar, has seen an explosion in supply. And that's a very important point, because you can supply something in greater number, but you need an increased demand, otherwise the price goes down. So don't be surprised if in the months ahead the US sees a run on the dollar. Now, that has huge investment implications, which we haven't got time to go into here. But the flip side is that if the dollar goes down in a disorderly way, it means that the Chinese currency, which has been artificially held down, goes up. And if the Chinese currency strengthens, or as it strengthens, as it will, then every family in China, every financial in China, every firm in China will become wealthier. So if you live in a country where you've seen Chinese tourists and Chinese investment over recent years, be prepared to see a great deal more going forward.
How do you view the future of the aviation sector, not to mention tour operators and major holiday resorts?
Clearly, they've been badly damaged by what's happened, because if you can't get on an airplane, you can't go to a hotel, and you can't go to a hotel, you can't visit a restaurant or a bar. But bear in mind, I'm not being glib here, if you think about the world before this crisis began, the single biggest theme was the environment. And you had young, rather naive Greta Thunberg telling us that we shouldn't get on airplanes, because they're bad for the environment. What she was telling us effectively was don't go to hotels or restaurants or bars in other countries, because to do that you need to get on an airplane. So this is dramatized how important it is to help the environment, which we all want to do, but to do it in a measured way. So what we've had in the last 3 weeks is an illustration of what damage to an economy bringing forward zero carbon emissions does. This is effectively Greta Thunberg and her acolytes have demanded that we bring ever more forward zero carbon emissions. Well, this brought zero carbon emissions forward to today, because there are very few carbon emissions going on in aircraft at the moment. And you've seen how much harm that does to an economy. Maybe the balancing between doing good to the environment and the economy has been one lesson that we've learned from this. Is to repeat, hotels and restaurants and bars can't be occupied unless someone is transported by an airplane. Clinical fact. If you're Spain or Greece or Cyprus or Malta or Ireland or any of the Philippines or Thailand or Australia, and you've got a fairly large tourist industry, and you want to protect the environment, then you know that you've got to change the way you operate economically. We're having some very, very powerful lessons taught to us in real time. And I hope those lessons are learned.
What shape will the UK state finances be in the medium term, given the simultaneous challenge of finalizing Brexit trade negotiations with the EU? Can Brexit go ahead as scheduled, given the circumstances?
There is no European Union. What is the European Union? It's a single market of goods and people. People aren't moving freely across Europe. They can't, they're not allowed to. Neither are goods. So the whole European Union model that we knew before this crisis has been destroyed. And it will have to be put together again. But the UK will have to rejoin other European Union countries on different terms. But so too will Spain and Italy. And so too will Greece and Cyprus. So too will Estonia and Lithuania and Germany and France. This is an opportunity for the European to redefine itself. Because as of March 27th, 2020, it doesn't exist. It's a fiction. The Eurozone does, because it's a single currency. But in terms of the thing known as a single market, that stopped the moment borders were shuttered up and people were stopped from flying freely across them. Let's hope we come out strong from this. And to repeat, what we don't want is the other side of this to be protectionism an isolationism. We want it to be a redefined free market, including China, including countries that have hitherto been kept out of European free markets.
Last year at the EMEA Investment and Economic Forum, you stated that the growing affluent class from China will massively impact the hotspot global jurisdictions that succeeds in attracting their overseas student markets. Do you feel that the coronavirus crisis will impact this trend into the medium term?
Not really. There's been an immediate shock because Chinese tourism and travel has been interrupted by this. But beyond this crisis, when China was the first country to go into this and it was the first to come out, what you're seeing now is it's stopping the arrival of foreigners into its country. In 3 or 4 months' time, when the all clear is sounded all around the world, just watch as the phenomenon that was China before is amplified. And the reason that will be amplified is that the wealth that we all perceive is linked in very powerfully to the value, the currency that we're wealthy in. I have sterling, you have euros. When those currencies move, we feel poorer or richer. Chinese have the RMB, their currency. And believe me, in a year's time or in 6 months' time, possibly sooner, their currency will become more powerful, more valuable. And with it will come greater ability to buy the things that we have and we want. So they're going to become a huge rival to us as buyers. Also, a great benefit to us if we have things that they want to buy and we can sell them because their wealth becomes our wealth if we can capitalize upon it. So yes, I agree. Not even my views not changed; they've been increased. The confidence in them has increased.
Given your market insight, we couldn't resist asking you to play a quick long short session to close. Is that okay for you?
Most definitely, yes.
I'm going to start with sterling.
Long.
The euro.
Against who? Currencies are only valuable in terms of exchange rates. So if you're saying euro sterling, I'd say long sterling and short euro. If it was euro dollar, I'd say go long euro, short dollars.
Lockdown.
If the question is how long it's going to last, I'd short the lockdown. It won't last very long.
A 4-day working week.
Nonsense.
Summer vacations 2020.
They've already gone. That train has left the station. If the question is 2021, normal service will be resumed.
And the last one is Trump.
Between now and November, this looks likely the US descends into an even worse medical crisis than Spain or Italy has done. The problem is that he'll be, you think about Trump in the context of a wounded animal. That's when they're most dangerous. And that fills me with fear. Because he wants to win another term. Because that's the way he works. And I don't know what he'll do to turn around his fortunes. And that, again, is a man who, when wounded, is liable to basically flay his arms dangerously around. The good news for us is that we've got a very sensible China. The Chinese have blame that's being apportioned to China because that's where the thing began. It's true, we can't deny that. But China has done a great deal. China did a great deal to rescue the world in the wake of the 2008 crisis. A great deal. And it never got credit for it. And I have no doubt that, yes, the virus began in China, but I have no doubt that the recovery will also begin in China. And it will help those countries like the UK and Australia and Canada, who benefit in turn from China.
Thank you very much for your insights, Dr. Savouri.